Okay, joining us now, we're getting a recurring guest. We get Barton, who is a little bit of a TGA account. And for those who don't know what the TGA is, Barton, why don't you tell us what it is?
Hey, Kevin. First, thank you for having me back. So TGA account is one thing that's very highly related to the debt ceiling that was just being raised a couple of weeks ago. And it's essentially the checking account for the US Treasury that's being hosted in the New York Fed computer. And turns out this is very important. It relates to the pressure selling or buying pressure of equity, US dollar, commodities, and a couple of things. So let's take a quick look at it. If you go to the next page, we first can see how TGA come into play about 11, 12 years ago during the great financial crisis. TGA wasn't a thing until essentially late 2008, early 2009, when the Federal Reserve started to pay interest to the required reserves and the excess reserves. So before that, all of the cash balances of the U.S. Treasury was basically stored in commercial banks. But after that, since Federal Reserve is paying interest to the commercial bank for these cash balances, it doesn't make sense for these billions of dollars to be stored in a commercial bank account. So that's a time when New York Fed started to be the basically custodian or the servicing bank for the U.S. Treasury. And
So
TGA
that
account.
was right. So that was when they had the introduction of the IOER, which was the interest on excess reserves. Is that correct?
Exactly. That's
Yeah.
exactly right. And that's why we only have about 12 years of history to look at for how TGA may impact US dollar as well as equities, for example. So this is two periods in the past when we also had a debt ceiling lift through Congress, highlighted here with these two color regions, one in 2015 and one in 2017. In both times, the TGA account went to very low balance as required by the law. Treasury basically had to spend all their cash because they don't have the authority to issue new debt. And after debt ceiling was lifted, TGA account immediately go up because Treasury like to keep about 150 to 350 billion dollars as rainy day funds for cybersecurity reasons and other reasons, depending on who is the Treasury Secretary. And as we'll see in a few slides, that actually started to create a bit of pressure on the US dollar and SPX. So the lower panel here showing what you're seeing here was US dollar from late 2015 and into today. And those two time period when TGA account went up from like $50 billion to $300 billion was highlighted in yellow and green respectively. And you can see that the dollar index actually raised by about $6. The yellow box on the left, within that 2-3 month period when the TGA was going up, and in 2017, during that ceiling resolution, TGA went up by about $150 billion, and the U.S. Dollar index went up by about $2.4. So that's
Okay,
a
so Barton, one second, Barton. I'm going to interrupt here just quickly and let's just go through the mechanics of what's happening here so people understand. When they're able to, they issue more debt. So the Federal Reserve or the Federal Reserve is actually taking liquidity out of the system because they're pre-funding some of the debt. Is that correct?
That's exactly right. And I have a few slides, 2, 3 slides later after this, and having a clearer picture about what's really going on.
Okay.
So I'm just having a very quick preview here about
Okay.
what's generally happening. And if you look at S&P 500, you can see in 2016 that yellow region, there was also quite a bit of selling pressure on the equity market as well. But in 2017, during that debt ceiling resolution, although TGA went up, uh, nothing seemed to happen to S&P. So the question is why? Why would
Right. Okay.
TGA affect equity and the US dollar differently? And would they affect equity this time or not? And what's really going on? So to understand this, it's useful to take a look at what exactly and how exactly TGA apply pressure to different asset classes. So what you're seeing here is the balance sheet of the Federal Reserve in New York Fed's computer. So on the left-hand side, you have the asset side of the balance sheet, and on the right-hand side is liability, and they have to be identical in total numbers. And when we do QT and QE, we're basically increasing the total size on both sides. And right now, we're not doing any of those. So the total amount is a constant. So the right-hand side, the liability, whatever grows in one piece or one line item means some other line items or some other piece have to be shrinking in order to vacate some balance sheet space for the other. So in terms of TGA, it's a checking account for the U.S. Treasury. Every single dollar that's going into TGA has to be balanced by a dollar that come out of some other pile of money on the New York Fed's computer, and in this case, most of the time it's coming out of this blue box, which is commercial banks reserves, and this is how TGA apply pressure to U.S. dollar and the equity market, essentially.
Right. Right. And
So. So yeah, so the detail of this is actually quite intricate because the U.S. Federal Reserve have or give bank reserve to both bank based in the U.S. or the U.S. branch of foreign banks, as well as many foreign banks, like banks in Europe or banks in Japan or even banks in China. And the total bank reserve is split between U.S. banks and foreign banks. So when TGA account balance fluctuates, depending on whether the dollar is coming out of a U.S. bank or a foreign bank, you will start to see a different reaction in the market. If the money is coming out of a foreign bank, you tend to see a huge pressure on U.S. dollar because that's translating into a dollar shortage for the on the euro dollar market, for example. On the other hand, if the dollar is coming out of the U.S. bank, then the pressure is more on the equity market or commodity market. So in this graph, very quickly, you can see that the yellow and then the green time period corresponding to the last two debt ceiling resolution was they have different profile on the foreign bank and U.S. bank. And foreign bank basically coughed up more money in 2015, which caused the U.S. dollar to under a lot of pressure to go up. And in 2017, the U.S. banks basically did not suffer much from the TGA account rise, and therefore equity was not affected, and it's more on the U.S. dollar as well. And here you can actually see the sell-off in Q4 2018, which is a blue arrow, when the U.S. bank reserve dropped a lot in the fourth quarter last year, when the foreign banks was not affected as much. And then in this year, 2019, even though it still had a QT for the first half of the year, most of the money came out of the foreign banks account, which become more of a pressure on the U.S. dollar as opposed to the pressure on the equity market or the crude oil market.
Right. So what are we looking at here on the next slide when you're showing here? Is this still
So what you're seeing here is the question to answer the question. Okay, if we know there is some correlation, does it mean that this is a tradable information? Every time the TGA account balance goes up, that would translate to a dollar index rise or something like that. It's actually not that simple. For example, the top panel here shows you the TGA account balance in the past 5 years. And there were periods of time, meaning 4 to 6 weeks period when TGA had a huge amount of inflow in cash, right? So that means either the Treasury is issuing a lot of new debt, or there's a huge amount of tax receipts, which usually happens around April 15th.
Right.
So that's the two arrows you have over there. And if you compare that with the dollar index chart at the bottom, during April of 2015, still previous, 2015 and the 2017. 2017 didn't really have much a rise in the dollar index. 2015 did. And the difference between these two different years to the reaction to the TGA account is because of whether the money is coming out of the foreign bank versus money coming out of domestic banks.
So you don't know actually in advance where it's going to come out of. All you know is that the TGA account is going to go up or down. Is that correct?
In principle, yes, but you can make a educated guess about what's going to happen. So if the TGA account fluctuation is coming mostly from income tax or any tax receipt into the U.S. Treasury, most of it will come out of U.S. domestic bank reserve.
Okay.
If it's
But
coming,
if it's coming out because Mnuchin has decided to pre-fund something, then that comes more out of the federal side?
it's
the
more
foreign side?
Foreign side, or at least 50-50, but more likely foreign side. So what's going to happen very interestingly right now is that for the next couple of weeks in August, when Mnuchin starts to increase TGA balance through issuing T-bills, you will probably see the foreign bank reserve getting affected first. Just like in this slide you're seeing on the screen, the foreign bank's reserve balance basically inversely correlate with the U.S. dollar index.
Right. So and we know you just told us that Mnuchin's already announced what he's going to do in terms of funding through T-bills, and we know that the TGA account is going to go up. So therefore, are you saying that the dollar should be, all else being equal, more strong going for the rest of the month?
That's more likely than the other way around, meaning dollar being weaker and equity being strong, dollar being weaker and equity being under selling pressure because the U.S. bank loses its reserve. So what's happening is actually through the rest of, if you go to, I think, 2-3 slides down, yes, here. This is my projection of how the TGA account will evolve in the next few weeks. And as you can see here, throughout the rest of August, we're pretty much flat. And the reason for that is we do have an increase in the T-bill issuance, but they're spending it out immediately. And the spending goes into U.S. domestic banks because that's basically Social Security payment, Medicare payments. That's all mostly domestic. So this will be mostly a money transfer from or bank reserve transfer from foreign banks to U.S. banks, most likely. So you'll probably.
Sorry. Well, does that mean that we will likely see a strong U.S. dollar and a stock market that hangs in there, like all else? Would that be your best guess?
Exactly. That would be my best guess.
And then what happens in September? I see that it expands dramatically. It goes from 150 up to 350 over the next 3 weeks. What is that from, and what's happening there, and what do you think is going to happen to both the stock market and the dollar from there?
Right, that's a very good question. So in mid-September, there will be a huge rise in TGA account balance. 2/3 of it coming from the September estimated tax receipt. So there are people who are contractors or self-employed, people who are paying for their estimated tax. And then 1/3 of it comes out of the 3-year, 30-year, and 10-year T-notes and T-bond issuance. So that should be mostly being put on, it's going to be a burden on the U.S. domestic banks, and potentially could be an interesting time for stock market to get affected, because this would greatly affect the cash flow of big banks and their ability to lend out money to hedge funds.
Yeah, so we're going to see potentially, and you highlight the fact that it's also the quad witching in the S&P, which won't help that at all. In terms of, and September is traditionally also one of the toughest months out there. Everyone thinks that October is always the ugliest month, but if you look, I think historically, September is almost as bad, if not worse.
Yeah, everything lined up perfectly. All the liquidity withdrawal will happen, but we'll be finished basically a day before the FOMC, Wednesday. This should all be done. TGA will go up to 300 billion. And then we have FOMC, which could introduce volatility to the market. And then you have option expiration, future expiration, and all of the fun stuff. So it'll be a very interesting week to trade.
Yeah, that's
September is going to be really interesting for sure.
And I think that this TGA is a relative, as you explained, the fact that it's new and it's something that we've only experienced over the last decade. Is something means that a lot of market participants don't really understand it as much as they probably should. And I think that anyone that is all interested have to make sure that they follow Barton, because he is the kind of the man when it comes to understanding these things. And I'm always shocked at the level of detail that you go in. I was joking around that I think that Mnuchin, which should probably ask you what he thinks the account's going to be, because you probably know better than he does. And he's busy, him and his wife are busy going around the world spending all their money, while Barton's busy running his spreadsheets and figuring out what it's going to look at. And don't underestimate how important this is in terms of how much it might affect the markets and both the U.S. dollar and the stock market, because I really think that it is one of the probably one of the best edges you can get out there that is being overlooked by the stock market. Now, so Barton, for those who want to learn a little bit more about you, I guess the best way to find you is Twitter?
Yes, the best way to find me is through Twitter, and here is my Twitter handle, Barton_options. And if you follow me there, I usually post the updates about the TGA balances and other things related to the Fed account.
And make sure you guys follow him, because he's a must go to when it comes to these things. And Barton, I'm going to ask you one last question before you go. So I spend my whole life trading options and stuff like that, and I thought that I knew all the Greeks. And I see you guys talking about Vanna, and I think you're talking about Vanna White, but you're really talking about something else. Why don't you give us a little? Why don't you give us a little 30-second spiel about what Vanna is? Because I see all you Delta heads, the Greek kind of masters talking about Vanna all the time. And why don't you just tell us a little bit about what that is?
Yeah, Vanna is this really interesting second-order Greek. Basically, it tells you how much the delta of an option will change as a function of the implied volatility change. So in other words, when VIX, for example, go up from 12 to 16, that's a 4-volt change. How would that impact the delta of an option? If Vanna is 0.2, that means the option delta will go up by 0.6. And why is this important is sometimes there are lots of options that has a huge amount of Vanna because of the option open interest tend to cluster in certain strikes, and if those strikes are at the highest Vanna region, which typically about 10 delta to 18 delta for puts, then that creates a huge amount of selling or buying pressure when there's a big volatility spike. So, for example,
I get it because. Oh, sorry. Go ahead. I'll let you explain it. Sorry. Go ahead.
So we basically experienced that this Monday when we gapped down, I think, 50 points, and we had a huge volatility spike in the first. Throughout Monday, but the first 30 minutes of the trading hours, there was a huge amount of delta generated on market makers' book, simply because of the implied volatility of all these options has been raised by many vols. And these market maker has had to delta hedge their book, and as a result, they were selling a huge amount of future and then pushed down the E-mini future prices quite a lot.
Right. I understand what you mean. Like the reality is that let's just assume. Here's another way of maybe I can explain it. Let's assume that for some reason, all of a sudden, the market became more risky, and it didn't move in price, but there was an event that we knew that we should move up the implied volatility of all the options and the volatility that these dealers are going to hedge their book at. You could get a situation where that change in volatility actually creates a delta that must be hedged. If I got it?
That's exactly right. And that also happened yesterday, Thursday, when they crushed the volatility about 5 vol to 6 vol between the 7-day to expiration to 90-day expiration options. And that created a continuous buying force in the market. And you saw the market just went up in a straight line. I think from 2,900 to 2,930 or 2,940.
So there you go. Now we know that Vanna is not Vanna White, and we just want to thank Barton for explaining that again to us. So make sure you give him a follow. You'll learn all about these things, and the TGA account, watch for it and watch for September. Could be a fun and exciting September.
we have to get Barton back here in early September to give us an update where all the numbers are. Because
for sure. Why don't we do that? Well, how about the second week of September, Barton? If you're willing to come back on right before the excitement and while the account's going up, I guess we'll have you on for another update in terms of what the TGA account's looking like. Sound good?
Sounds good. Yeah, I'll see you guys then.
Okay, all terrific. Right. Have a great rest of the summer, and thanks for coming on, Barton.
You too. Take care. Bye-bye.
Bye.
All right, Barton. Thanks a lot.
Is that good?
Thank you. It was perfect. It was a great amount of things. I should have warned you on the Vanna, but I figured you knew what you're talking about, that you were going to be fine. That was awesome, buddy. That's exactly what we need.
Yeah, so you have some extra slides. We can always circle back to these.
I can tell you guys what's going to happen. That's something nobody's actually talked about so far. Just seeing like 2 minutes. So if you go further on the slide deck.
Oh, okay. Hold on. Let me pull it up.
Yeah. So this is something really fun, and then it actually happened when the bond market went crazy.
Okay, where do you want me to go? Which
so
slide?
Just go to slide 21, and then zoom in on that. So that's the yield curve, right?
Right.
So what happened was now that 10-year, 5-year, 3 months, all the T-bill, T-notes are below not only IOER but also the repo rate, right?
Right.
Central bank will not buy T-bill, foreign central bank will not buy T-bonds or T-notes anymore. They will just park their money in the Fed for so-called foreign repo pool, which is the savings account for them that's paid the overnight repo rate.
Right, I get it.
So that removes all the a huge number of bidders for the T-bill and T-notes, and then the side effect of this is that the foreign repo pool, so lower panel, plays exactly similar as TGA. It's a line item on Fed's balance sheet. If this grow up, if this number rises, the bank reserve will shrink. So in the past 4 weeks, the foreign repo pool should be flat, but it rose by about $35 billion, which is not good for bank reserve. This is a stealth QT that's going on. Everybody thought QT is over, but no. Because of the yield curve is so inverted and we're doing IOER, if this trend continues, we're going to see a $30 to $40 billion of a reserve loss from banks every month.
So basically, that's saying that the Fed has to lower IOER to get it below that, so that the central banks go once again and start buying T-bills.
Yep. So they have to cover.
Yeah, I got it. Yeah. No, I hear what you're saying.
And this is
otherwise, and this is a way to measure it almost.
Yep. And this is going to be, Trump doesn't have to do all the China trade deal stuff.
Now we have to keep this in the recording now, so we're not over yet. So the rate cut's coming.
Yes, it is. Well, unless Fed is going to do something radical here, they're going to cap the foreign repo pool. But I haven't seen any sign of they're doing that. I don't know if they.
They're not good. They're not going to do that. They're just going to lower the rate. They're just going to lower the rate.
Right. So basically, how much 5-year and 10-year is going to continue to go down will determine. But yeah, well, essentially they have to follow the 5-year and 10-year, and this is a path to zero very quickly, right? That's my
Right.
take on this.
Okay, hey Barton, is it okay if we leave this in the recording?
Is this polished enough, or?
Yeah, for
for
sure.
sure.
Why not?
It's a market huddle polish, buddy. It's good enough.
Okay. Well,
But I mean,
Great.
this is why the market is pricing in the rate cut, isn't it? Like, I mean, arguably, this is why everyone's calling Powell's bluff, isn't it? Like, I mean, it's being baked into the cake at this point, isn't it?
but they're really become a slave of the bond market right now. If this trend continues, I see we might go to zero in like less than 12 months, right?
What?
Yeah. I think though what Barton's saying is that this is actually causing stress in the system.
Yeah.
And he's showing you why with the bond market is
Yeah.
actually moving around and will cause problems in the banking system if we trade below the IOER. So that the
Right.
fact is that they have to get this IOER below the where the actual T-bills are trading. Otherwise, you're going to get this account continuing to grow, and then that will be a problem for risk assets and for banks. Now, is that would you agree with that, Barton?
Right. That's exactly right. Or
Okay.
they
Awesome.
institute their standing repo facility, but that's not going to solve this problem for like
Yeah.
this. It's not going to give you hundreds of billions of dollars of liquidity. It could give you like maybe 20 or 40, but not this much.
Nah, they need to cut, and this is just another sign. Anyways, thanks again, Barton. We'll talk to you in September. Have a great rest of the summer.
You too. Yeah, great talking to you as always.
Thanks,
Okay,
Barton.
take care. Bye-bye.
Cheers. Bye-bye.
Bye bye.